So hi all, this is Jeff Hulett. I'm a decision confidence builder and I'm your host today. And I'm super excited to talk with Daniel Hulett. So today we're going to be focusing on the investment barbell strategy. So this is the fourth in a series of investment barbell strategy discussions. And please go back, if you'd like to go back to either to the Curiosity Vine or to my YouTube channel. The earlier three are there for you. Not a bad idea to walk through them. We're going to be talking about a lot of things that we sort of built up to today, but certainly even without seeing them, I think you'll really appreciate getting to hear from Daniel. The idea is, Daniel, we're going to make the investment barbell strategy real. We're going to be using a live example here with Daniel. So first of all, Daniel, thank you so much for being here.
Thank you for having me.
Oh, of course. So Daniel is the president of Hulett Brothers, which is a content creation business. And coincidentally, he's also my son who's home for the holidays. So first, Daniel, I'm sure the listeners would love to hear a little bit more about the Hulett Brothers. Could you tell us a little bit about your history and especially how Hulett Brothers has created an economic opportunity? Like, how and does content creation make money?
Mm-hmm. So me and my brother started this whole business back in 2020 when we were sent home from school. And over the next couple of months during COVID, it kind of quickly took off. We gained a lot of traction over the internet. And I think both of us were kind of like, wow, there might be some chance here to make money. We've seen we've seen people do it on YouTube and other things like that. So we kind of took it and ran with it a little bit. But kind of fast forward to today, over the last 3.5 years, we kind of make money two main ways. We get reached out to by brands. Like we've worked with some big brands just recently, like Netflix, or done some stuff with Red Bull. We had a long-term partnership with Sunny D. I don't know. We've probably now worked with over 30 brands over the last 3 years. 30 different brands, yeah.
Okay. Wow.
So just mostly consumer brands that you probably see, tons of different advertisements like them all over the internet. For a while, that was kind of more of our main source of income, but also.
Can I ask you a quick question? Because I'm really curious about this. Because I'm an old head here, so I remember you did something with Wimbledon, which I thought was amazing. Now, did you actually get tennis rackets to do that, or
yeah?
But they pay you plus you get like really cool stuff. Is that kind of
obviously the money is great, but my favorite thing is the free stuff. Free stuff's fun. Stuff's fun. Yeah. So we worked with Wimbledon over the summer, which was really cool. They sent us some tennis rackets, and we promoted the Wimbledon Brick Breaker app game, which was pretty cool.
Good.
Yeah.
All right. Well, thank you for that, Daniel. And actually, I wanted to point out, take a little aside here. So we're going to be talking some numbers here today. We're going to be walking through the what's called the savings waterfall and then the investment barbell strategy. So the numbers, the detailed numbers, the specific numbers are all fictional, right? And it's really to protect Daniel's privacy. But what I want you to know is everything we're going to talk about in terms of robo-advisors, products, accounts, strategies, those are all very real, okay? Only these specific numbers aren't exactly right. The other thing that we're going to be showing and showcasing are some of the tools that are so important to help Daniel with his process in his life, and me also as a strategic advisor, helping Daniel with the investment barbell strategy. These are the tools that I use also to help Daniel understand where he is, and then to develop the strategies for, we call it the progress, not perfection mindset, right? The world's dynamic, everything changes. The idea isn't to be perfect. If you hold yourself to a perfect standard, you'll probably never get there. The point is, we need to adapt, improvise, adapt, and overcome, just like the U.S. Marines. So anyway, so that's what we're going to be talking about today. So, Daniel, the content creation business you and David created in the pandemic is absolutely amazing. Like, I call it the silver lining story, right? You guys started with basically living in our basement, figuring out what you were going to do, and decided you wanted to be famous. Hey, why not, right? And then you took it from that, and I don't, you really used the pandemic as a fabulous opportunity, but obviously it's to you and your brother's credit that you're able to really do what you did. So next we're going to really focus on how you manage your income after you get paid by the Hulett Brothers, right? But really, I think, and we call this the savings waterfall. I have that chart there that kind of lays it out. But being a business owner is a little bit different than being an employee. You are an employee of your own business, but you're also responsible for the revenue that flows through the business that provides for your salary. So before we get to your income, can you tell us a little bit about how the financial side of your business works? And in particular, I know we settled on a company called a bookkeeper and tax partner called Cookie Finance, which I think has worked out pretty well. So tell us a little bit about how it works with them, and just a little bit about how the business and the money flows through to get to you.
Mm-hmm. So I was kind of saying earlier, a big chunk of our revenue stream, our main revenue stream, is through advertisements, so different brands. So those are all, we figure out the deal with them, and they're all different terms. Net 30, net 60, even some net 75, which can be crazy. But eventually we do.
Wow.
Eventually we get paid. Nice. Yeah, eventually we get paid. So it runs through our business. We recently started working with Cookie Finance, who's our accountant, and they helped us kind of set up our whole back end of our business, which has been fantastic.
Do you sleep better now? I
do sleep better. Yeah, we're very happy with our new accountant. Feel a lot more confident. Sorry, where was I going? How it flows. Yeah. Right. So for the longest time, about a year and a half, 2 years, David and I, we weren't actually a real LLC. It was just two individuals. So just this year we became Hulett Brothers LLC. So we're an official business, and now I can get W-2 for my own business and everything, and we're on salary with them. So that's made a lot of things a lot cleaner and easier. But yeah, so me and David are on salary. So every month, comes out of our bank account and then goes into our personal bank account, which is kind of funny. It's a small business of two people. But then from there on, as I guess we'll talk about here in a second, I'll take it from my personal and move it into other accounts.
All right. Well, no, thanks, Daniel. That makes a lot of sense, and it's I'm guessing not every small business like you stands up a capability like a Cookie Finance and really thinks about the back end of their business as much as they're thinking about how do we do more trick shots, how do we drive more revenue, how do we get more clients, etc. So it's probably not the funnest part of your day, I would guess, but it's the discipline of business. Yeah, absolutely. So let's kind of skip through the waterfall a little bit. And I want to remind everybody that there's really two parts here. We have the waterfall, and that's basically how the money gets from income to a point where it's ready to go into long-term investment, right? And so that's really the cash part of it, which we had on the last screen. What's at the top here is really the investment barbell strategy in terms of showing how the cash gets converted into the investment barbell strategy, right? So, what's interesting to me is the savings waterfall, isn't the sexiest part of the process, for sure, but it's the way cash gets converted into the barbell. So without it, kind of nothing happens, right? Mm-hmm. So anyway, I just, as a reminder, I wanted to kind of share that with folks. So now, Daniel, let's go ahead and walk through the waterfall for you, and we're going to go ahead and really, here's the waterfall itself. Again, a reminder, it starts at the top there, and that's the budget and the expenses, right? So this is really, it's flowed out of Daniel's business. Now we're into Daniel's personal life here. And you can, at the very top of that waterfall there, you have basically what is needed to pay Daniel's expenses, we'll talk a little bit about, but also what's saving eligible. And the way the waterfall works, remember, it waterfalls down. So the next level is a couple months in your checking account. We recommend 2 months. And then once you build up that 2 months, waterfalls down to the high yield savings. And that's really the buffering part, getting ready for the investment barbell strategy and the investment portfolios, whether it be robo, real, or fund. So anyway, so that's really the waterfall itself. But let's go ahead and really kind of dig into each pieces of this now. So Daniel, tell me a little bit about how you budget. You talked a little bit about Cookie, and I'm guessing working with Nate Coffrin and the Cookie team, they've got you on a pretty disciplined process. But once it flows through to you, for you personally, how do you think about that?
Yeah. So I mean, I'm not perfect, obviously, but I try to set up automated investing as best I can. I have that set up for my retirement, but kind of my other main budget, I kind of like looked over, or let like kind of 6 months of expenses go, tracking it every month, and kind of from there set up a pretty, workable budget that I try to stick to every month.
Now, do you use a tool for that? Or
Yeah,
is it more like an Excel spreadsheet?
Google Sheets. Google
Google
is my
Sheets.
Excel. But
And you made it yourself, kind of?
yeah.
Okay.
I looked up Google a little bit, see if I could see some stuff, but
Right.
kind of main categories. But
Well, and I just want to point out to the listeners, that's a wonderful way to do it, right? Google Sheets or Excel is great because then you own it, you're building it yourself, you kind of have to learn it and understand it. But there are a lot of other ways to do it as well. There's several different tools that are kind of templates that already exist out there. And by the way, in my book, Making Choices, Making Money, I kind of give you a list of all that stuff. So if you're interested, please do check it out. But honestly, I love the idea of building it yourself. And I remember you were a finance major in college, so
yeah.
let's think that helped a little bit too.
Yes,
So how do you think about your expenses? I'm kind of thinking about like your more of the attitude side of it. Like, you're in a growing business? Does it mean that you're buying lots of expensive things? Does it, how do you just sort of get in the mindset of either saving and sort of managing your personal expenses?
Yeah. I guess I've never been necessarily a big spender, but I try to stay disciplined, I guess, eating out like once a week is kind of my goal with something like that. Other like fun expenses, like I like to play golf a lot, so I kind of have myself a little golf budget for a couple rounds, maybe 2 rounds a month.
Right.
So
which is good for your business, right? It's good practice.
It is, yeah.
Right?
I do some golf trick shots for sure.
Yeah. Well, good. So I did notice that you are putting 25% after running it through the tool. Basically, it works out that you're putting about 25% of your gross salary is going towards your SEP IRA. And for listeners too, most folks are probably in 401ks and traditional retirement programs. Because Daniel's his own business, he has a little bit different. It's called a SEP, or self-employed person's IRA. It's very similar to the 401k. But I'm more curious about 25%. That sounds like a great number, but I was curious, was that hard to get to? Like, did you have to feel like you were scaling back things, or no? I'm just curious.
Yeah, we definitely, me and David definitely looked at it and tried to kind of figure out the best percentage possible, because we both wanted to stay on the same percent. But after looking at it, I mean, I definitely scaled back a few things, but generally it was kind of already there. I just need to move the money.
Right.
More so.
Right. It is funny that we talked a little bit about automations, and I think sometimes that becomes one of the biggest challenges, is not knowing what to do, and not even knowing whether it's hard or not hard. It's more just remembering to do it. Right?
Yeah.
And of course,
100%.
Behavioral economists like me, we talk about commitment devices, and the automations are so important. I can't really emphasize that more. So, but let's talk a little bit now about your checking account, and both your checking and your high yield savings, that after going through the analysis of the tool, comes out to be about $14,000 for each one, which I've noticed after going through your current account balances, you're about there. So first of all, I want to congratulate you and say that's awesome. And remembering, this cash has two purposes, right? It is for emergencies. It's for liquidity. Stuff comes up, right? You think you got a budget, and of course, that big car expense or something comes out of the blue you weren't expecting. But also, these cash budgets are for something, for me, even more powerful. That when I think of it as opportunity cost, meaning if an opportunity comes up to make an investment or to do something with your money, having some cash on hand to be able to deploy in those situations is great. So anyway, so you're the good news is I have nothing bad at all to say about that. You make me feel good. It makes me feel good that you've got that going. So in terms of the next level down, the waterfall, we're going down the waterfall. Now we're at the high yield savings. So tell me a little bit about you know, it's one of the things that where we're starting to get into yield, right? So the checking account is a 0% interest. It's your transactional account. You can't get the bank usually to pay you for a core account, but high yield savings is different. It's where you start earning yield on your money. $14,000 if you're keeping that as an average balance. That's a reasonable amount of cash. So just curious, do you know what your interest rate is in your high yield savings account?
I think it's around 5%.
Around 5%?
Through Wealthfront.
Okay. Okay. Well, you know what I have to say is, I've worked with Wealthfront for a number of years, for personally for me as well, for some other clients. And what I find is actually, in general, Wealthfront keeps their high yield savings pretty close to the top of the market. It never is at the top, but chances are it is probably a pretty good rate. But the only thing I wanted to suggest to listeners and folks, why it's so important to check it out for Daniel's level, 14,000. If he was 1% below, that would be worth $150 a year. That's what 1% on 14,000 equates to, about a little shy of that. So, hey, it's dinner, right? It's a really nice dinner, especially in Newport News. Yeah. So, why not? It's as simple as checking to make sure the rate's as high as they can be. And look, they're all FDIC insured, right? So there's no difference other than taking the time to find it. So great, great. I'm glad you found yourself a good high yield account. So now let's kind of keep on trucking down the waterfall here. And so I did want to ask you about, this is now where we're sort of exiting the cash side and starting to look more towards the investment portfolio and your long-term strategies. And the big thing, I guess, before we leave that is the automations. How do you feel about your automations, about being able to move the money to prepare for that long-term investment?
From cash to
from cash into going, like, either being moved to Wealthfront, right? Basically, so out of basically your checking account into Wealthfront, and then ultimately into, say, an after-tax Wealthfront investment account.
That's probably where I've honestly struggled the most. I have pretty good discipline on the automations for my retirement accounts, but for my personal Wealthfront investment accounts or long term, I just kind of, when I feel like I can make an investment, I do.
Right.
Which I know maybe not necessarily the right thing to do, but it's I've been meaning or wanting to work into be able to make an automation for long term.
Yeah.
But,
well, that's all right, Daniel. Instead of an A+, maybe it's just an A. 4.0 to 3.8 here. But let's work on that, because that is, I think, something, because at the end of the day, you need to focus on a couple key things with your business. Setting up the automations means that you set it and forget it, right? Yep. So anyway, but we'll work on that. Finally, I did want to point out too, one of the parts of when we do these reviews for other clients too, is we do look at credit. And Daniel, you pull, everybody gets free credit pull once a year. You did yours last, and you have a 735 FICO score. Amazing. So I think that's great. So I'm just curious, how do you keep it so high?
Yeah, well, paying your bills on time for one thing. I think with that though, I'm not perfect in automation with everything, but what I am strict on is automating any kind of credit.
Right.
I think that just makes it easy. Utilities and credit cards, just obviously never carrying a balance, number one, but paying off your balance every month, right, and just automating that. I mean, I think that's the easiest way to do it, and it keeps you honest.
Yeah, and really that high credit score equals access to credit equals access to cheap credit. So to congratulate you, when it comes time, we're going to talk about your real estate portfolio, to get another mortgage, to get a credit card, to get really any forms of credit that are prudent, necessary for your life. It's all about that high credit score, right? Because that's what ultimately drives both access to and the pricing thereof. So anyway, so that's amazing. So let's go ahead and kind of move on now back into the waterfall. We're going to now jump from the waterfall up into the barbell strategy itself. So first of all, as a reminder, there are 4 quadrants, and generally these 4 quadrants are based on 2 risk features. One's called diversification. Is it highly diversified or is it not very diversified? And then the other dimension or feature is volatility. How volatile is it? Is it very volatile, meaning it moves off the average up and down? Or is it not very volatile, which means it really doesn't move off that average very much? So those are the key dimensions, the key features that really the 4 quadrants that are really on focus for our investment barbell strategy. That's the basis for them. So it's very risk focused, but the big thing to remember is we are not here to eliminate risk. We accept risk and we want to take the correct risk. It's really, all of this is really all about eliminating ruin, right? Which means the chances of going bust. But I don't want, and this is really important, we must embrace risk. And that's really what this barbell helps you do in a really disciplined, appropriate, evidence-based, research-based way. And the good news is it's relatively simple to implement. All right, so I ran Daniel's financial life through the IBS tool, and so the first thing is Daniel does have about $250,000 in investable equity, which for a 24, almost 25-year-old, Daniel's birthday is next month, by the way, is amazing. Not everybody has that when you first got started out. Daniel started a little bit early. He started his business when he was in college, so he does have a bit of a leg up, right? In terms of, doesn't mean other folks, of course, will get there. It just might take you a little bit longer just because you started a little bit later, and that's absolutely appropriate. So the tool shows that you're distributed across the 4 different segments. So let's take a look at that real quick. So just real quickly, yes, 13% in cash, 62% in the robo, 8% in real, and 17% in fund. So those are the breakdowns there. So what we're going to do now is we're kind of step through each one of these, and Daniel's going to kind of talk a little bit about each one. So let's go ahead and start with cash. We've already kind of hit on the cash, but what it shows is, I guess the one thing I was just curious about, Daniel, is how often do you get distributions from your company? So you get a salary, but tell us a little bit, since you're your own owner, I'm assuming that every once in a while there's excess cash that gets distributed. Is that like well known in terms of how regular it is, or not so much?
We actually have a monthly meeting with our accountant, so we kind of review all those things, and he kind of lets us know where he thinks we are. But we more seriously look at it like maybe every quarter or so, and if we feel there's there's no need for the cash necessarily in the near future, right, we will take distribution.
So with on our cash quadrant here, it does show that it's a little bit over, which just means you're holding perhaps a little bit more cash than what you need. But your situation's a little bit different in that your company's growing, and we're going to be talking a little bit more about that later. But my guess is you're probably going to grow into that, meaning it doesn't necessarily mean you need to reduce the balance of cash. It just means as you grow over time, it doesn't necessarily mean you need to collect more cash. Mm-hmm. Okay, so that's kind of the way that kind of falls out. So let's go ahead and skip up to robo. So the IBS robo quadrant shows that you are a bit overweight. We'll be discussing real estate a little bit later, and really as an opportunity for the use of some of that fund. So the good news is you've gotten the cash out of cash and you're getting it into an investment vehicle. Right now it's into financial investments. And by the way, this robo is really broken down between your SEP IRA as well as your after-tax investments, both of which are in Wealthfront. So what I'm real curious about is tell me a little bit about risk taking. Like when you signed up for your Wealthfront account, like I recommend a handful of different ones. Wealthfront is just one, but each one generally takes you through kind of a risk personality assessment. So tell us a little bit about your risk personality.
Yeah, I think just for my personality, I'm definitely a little riskier, I guess you could say. But yeah, after going through the exercise, I'm young. I'm looking to have the highest return and all those different things. So I came out to a 10.
Okay.
which is the highest risk for actually like all of my accounts. So that's where I sit now.
Okay.
Mhm.
Okay. So so that makes all the sense in the world to me. So as in my economic brain, I kind of go, okay, like you said, you're a young man, young person. Time is your friend. Say you need this cash in 40 years, we'll go through 4 to 8 business cycles by then. You can ride through so many ups and downs. So taking advantage of the volatility risk, which a 10 means it's going to be higher volatile, but being very diversified, which eliminates the chance of ruin. That makes all the sense in the world to me. But here's the question I really want to ask you. Let's get real here. What if, say, you had 62% of 250,000, whatever that is, say it's around say in the mid 150s. Let's say that we got a massive hit to the stock market, and that 150 went from 150 down to like 90 overnight. How would you feel about that?
I mean, I don't think anyone would feel too good about that. But at least for me, I mean, that would be terrible. But I would say, at least for me, like the majority of the money I do have in there, I feel like I'm keeping it. I feel like I'm keeping it in there till I'm 50 years old or so.
Right.
At least that's how my mind is set right now.
Right.
So that's at least that
Okay.
would stink, but
Right. Well, what's interesting, it makes me think of is behavioral economist Richard Thaler. He's a Nobel laureate. He said that there's increasing evidence, and this is totally econ speak, right? But economist speak. There's increasing evidence that people should pay less attention to the ebbs and flows of the stock market. And I think Dr. Thaler's point really is if you have that long-term mindset, why make yourself suffer? Right, by saying, oh, it's way down, or oh, it's way up. I mean, it's just when you have the confidence to know, well, look, in 40 years, it will be up. So, but I like, but what I always end with is, it's all well and good to say that, but the big thing is buy low, sell high. But if you get freaked out of the market, you're basically doing the opposite of that, which is buy high, sell low. And you want to avoid that. So it's, to me, this is all about, let's get real. What can you really handle? Daniel's a 10, and he feels comfortable with that. If for some reason you're not, start with a little bit lower risk number, and then over time you build your comfort and confidence. Remember, progress, not perfection, right? So you can increase it, and that's part of what the process here is, working through the barbell strategy. So I did want to ask you a little bit about. Is your retirement set up as a Roth or as a traditional IRA? And do you even know what the difference of those things are? I should ask.
I remember looking up the difference not too long ago, but I do have a Roth IRA.
Okay.
It's something with before tax and after tax, right?
Yeah. So basically, for a young person, generally below 35, which you are, the Roth is advantageous. You end up paying more tax up front, but it's tax-free through your life and at the end of your life, or when you retire. So for a young person who's in a high growth mode like you are, it makes all the sense in the world. You're paying a little bit more, but end up with a lot more at the end. The traditional is kind of the opposite of that. Pay nothing now, but when you retire, you'll get the tax bill, right? So it's, it really depends on how disciplined you are in putting the money away. If you've got a really nice approach, which it seems like you do, the Roth sounds like the right thing to do. So that's great. Well, let me ask you this, and thinking more about that 62%, if it's a little bit high. Do you have any other big expenses that you think are coming up anytime soon? Like, do you need a new car? Is it possible there might be wedding bells in your future?
Yeah, maybe not in the short term, but in the midterm, definitely a few. I mean, honestly, maybe another real estate investment, or potentially a marriage, or even a new car. All three of those things are kind of on my mind. So, yeah.
Okay, so part of how we handle that is we have the robo account. We can subdivide those. Sometimes it means you have to move them to actually different robo advisors. But if you have specific things that you're saving for, keeping these little mental accounting buckets make a lot of sense because they have different timing, right? And you can adjust your risk tolerance Remember, risk is a function of time. So if you're being a 10 for your long-term investments, 40 years makes all the sense in the world. But if you have something that's 3 years from now, that's where scaling back that risk tolerance, because you know you're going to need your money, you're not going to have the advantage of time. So anyway, but we can focus on getting some of those earmarks set up. Okay, so let's go ahead and move down to real. All right, so this is really real estate. It says this shows, as you can tell, 8%, well under where the tool, the investment barbell strategy suggests you should be. But here's the thing: you're 24 years old. The fact that you have any exposure to real estate is almost just short of a miracle. I mean, most people right out of college are not thinking of buying a house, and I think this would be really great for folks, our listeners, to hear about. You did something a little bit different, right? You bought a house, but you did what's called a co-investment. So what you did is you got a couple of friends and your partner, my son, your brother, to go in together. Tell us a little bit about that and how that's worked out.
Yeah, so right around a year ago, I decided, my brother, my girlfriend, and my friend kind of all decided we kind of wanted to buy a house, but didn't think anyone individually maybe could have done it. So we decided to do it together with the intent to have a rental property here in the future.
Now, where is it, out of curiosity? Like, why do you think it should be a rental property?
It's really close to a university, so we think there's a high chance that we could turn it into a successful rental property.
Nice.
Thank you.
Yep.
So yeah, we decided to get a house instead of rent, and I think we're all very excited about it. It was definitely a lot of learning in the process, but we figured it out. We had some outside help as well, and now we're here today. Yeah.
Nice. Well, so was it hard to get a mortgage? So this is all your first time, obviously. So your first time home buyers. This seems unusual. Did the mortgage markets seem like, was it hard for you, I guess? Like, what was your take on the availability of mortgage products to help you do this?
Yeah, I thought it was gonna be more difficult, honestly, with 4 people going in. Since we did have the first time home buyer, we got the 3% down payment, which was helpful. But they actually ended up only taking they only needed 2 people's information, I guess, because most people don't buy houses with 4 people.
Yeah.
But once we had that and that was all cleared away, then it was smooth sailing from there.
So just I gotta ask the question: how is it living together? Like, are you guys splitting up the chores? I mean, is it like, I could just see when I hear 4 unmarried, 4 people, young people coming together, and I know, of course, it's your girlfriend too, but how does that work? Has that been okay?
Yeah, it's been pretty successful, I'd say. Obviously, we basically split everything 4 ways. It makes it easy, no headache, and I guess we generally do split the chores too.
Yeah. So when I helped Daniel with this, and we actually helped set up an operating agreement,
Yep.
right? So what's interesting is when people go into a co-investment, that's like the honeymoon phase, right? Everybody's excited about buying the house.
Mm-hmm.
But what are all the things that can happen in your life 1 year, 2 year, 3 years in the future, which may cause some stress, right? So the operating agreement is all about sort of exit rules, right? Like, how do we do this gracefully so we keep our relationship strong, but also have something we all agree with up front. So if or when change happens, you either agree with each other about how to handle it, or you always have the backup of the exit or the operating agreement to sort of to rely upon. And then I really congratulate the 4 of you for really doing that. I remember setting it up. It was about 4 or 5 pages. You can find these on the internet. It's the sort of thing, it's worth doing. It's not that hard. So the other thing, since you did this, would you say a year ago or less than a year?
We started the process about a year ago. We purchased the house in late April.
Okay, and the reason I ask is I'm thinking interest rates, right?
Oh, yeah.
I'm an ex-mortgage guy, so this means that you've bought not at the height, but probably certainly off the low or off the bottom, all right, of that, and so Tell me a little bit of how you're thinking about refinancing, or have you thought about
Yeah.
refinancing?
Well, yeah. So we got in April. So interest rate was around. I think we got it at like 6 5/8. So definitely not an exciting rate. We are excited for it to go down and refinance hopefully in 2024 if the opportunity arises.
Right. Right. Good. Well, we'll keep an eye on that. I'll certainly keep an eye on that too. Okay, so let's now for the final quadrant. Number 4, fun. So Daniel, you're kind of right there, where you want to be with fun, maybe, in the higher end of the okay range, right? So that's all good. I was really curious though, crypto. You're a big cryptocurrency guy. Can you tell us a little? I'd love to hear a little bit, or I'm sure the listeners would too, love to hear a little bit about what kind of crypto you own, and kind of walk us through the investment thesis. Like, why does it make sense to you?
Mm-hmm. So actually, back in 2020, I got COVID for the first time and was in my house locked away, sadly. But I started researching or seeing a lot of things about cryptocurrency and started researching it. And that's kind of like really all I did for about a week or so. And just it really grabbed me. And I thought it was really interesting and cool and had a lot of upside and a lot of potential. So back then, that's kind of when I made some of my initial investments. My main 2 cryptocurrencies I own are Bitcoin and Ethereum. But yeah, I mean, I guess obviously it is in my fun category. It's definitely much more riskier, but I see it slowly is getting more adopted, and I think it has a future in our world. So I thought it was a cool investment and a good investment. So
okay,
yeah,
well, good. Well, as an economist, crypto makes me feel uncomfortable on many dimensions. Just the word currency. It fails literally if there are 5 rules of what a currency is. It fails all 5. It's more like a crypto, I guess, baseless commodity might be a better name for it. But anyway, it's your fun category, and you've done the research, and that's what matters. What I would suggest is perhaps if it comes time to expand fund, which it will at some point as you grow, there are other ways to engage where you're with even other strategic sort of investments, which could be through ETFs. For example, I'm into CBD, for example, and other things. Like disruptive technology, nuclear, So anyway, there's almost an endless number of different interesting fund categories where you can focus on some real high value investment opportunities, and you can even buy through ETFs, which does take off some of the diversification risk.
Mm-hmm.
So anyway, but that'll be on our list for the future. Progress, not perfection, right? So here's the thing, Daniel. Let's start wrapping up here. So you're in great shape. It was really amazing to hear about your business and really, stepping through the process of, you're a content creator. You've set up a business in a way with the help of Cookie Finance to really get your operational back offices in check, so the money flows through, right? And then once it flows through, then you work with the Investment Barbell Strategy and the Savings Waterfall to basically flow it all the way from your business through your business to you personally, and then to get you into a well-weighted barbell. You have some opportunities. I think real estate is in your future, which we'll work on, of course. But in general, great job.
Thank you.
And really appreciate being able to really describe a success story here, and really for folks that are listening here, check out the Investment Barbell Strategy. We have the tools out on the website. They're out there available to you. My book, Making Choices, Making Money, I describe a lot of that. It's also a helpful resource. So anyway, lots of great resources out there, either free or very low cost to use. So please take advantage of them. And Daniel, we'll talk again in a quarter or so, and to continue down the process. Progress, not perfection, and we'll continue to move forward. So anyway, thank you so much, Daniel.
Yeah, thank you for having me. It's been fun.
Yes, indeed.